Hello everyone, welcome to a product review at Phenomenal. Today we are going to discuss different US focused funds trading in India. So starting off with, I think the most well-known index is S&P 500 index, which is the top 500 companies in the US stock market. So all the five funds here are US focused. The S&P 500 top 50 only has 50 stocks, the top 50 stocks in it, and the Nasdaq Q50 has a bunch of fund of funds. They have FANG ETF in it. They also have Nasdaq ETF in it. So they are just having multiple ETFs in this fund, and Nasdaq is the top 100, excluding the financial sector. So mostly this carries a lot of tech companies, and the US equity opportunities is an active fund. So they basically decide on which stocks to buy or sell. Just looking at the performance, the good thing about this analysis is that all the index funds here, right? So the S&P 500, the S&P 500 top 50, the Nasdaq, these things have done well compared to the Nasdaq Q50 ETF, which has done really which has underperformed all the major indices here, right? And it's not just like a few year, 1 or 2 years or few months, right? Like right from the inception, it has consistently underperformed all the basic standard benchmarks in the US. And also the Nippon India US Equity, the active fund, it has not lived up to the expectation for the amount of fees it's charging. We will get into the fees part later, but all we can conclude from this is that the index funds have done well, and S&P 500 and Nasdaq 100 ETF, they have done well compared to the other funds, US focused funds here. When we are looking at the risk return, right, so basically the Sharpe ratio. So in terms of just basic Kager, the Nasdaq 100, as we saw in the performance chart, comes to the top, but also it comes with the higher volatility. So that's something to look into as well, right? So the volatility is almost 23% compared to S&P 500, which is 16%. That's a massive difference, right? So the difference in Kager is not that high. So here it's 13.27. Here is almost 11.5. It is bit. There's a bit of a difference, but for the volatility that you're getting, you should also look into the risk or the volatility of the stock itself when considering the Nasdaq 100 fund itself. When we are looking into the risk, especially during the 2020 market sell-off, right? Almost all of them are exposed to the equity markets, right? So this is nowhere to suggest that there is no diversification in one or two of the funds here, right? So just for analysis sake, you can see in 2022 the S&P 500 didn't drop as much as the other funds here compared to, let's say, Nasdaq ETF or even the S&P 500 top 50, issued by Mira Asset Management. S&P 500 has done well in terms of just 2022 protecting your money here. But this is just a seems like a one-off case, right? So this is nowhere to suggest that it has more diversifying benefits, right? So when equity markets go down in the US, you can see that almost all of the major indices go down at the same rate. Now, going into what kind of sector. So as these are all like international ETFs that we already saw right at the introduction itself. We can see that it's heavily exposed to the information technology. More importantly, you can see the modular as well. Nasdaq, as I mentioned, is more exposed to the technology sector compared to the S&P 500, which has 43%, which is again quite high, but not as high as Nasdaq, right, which is 70%, which is a lot. And also, since the Mira asset is only investing in the top 50 stocks, you are, by virtue of just picking the top 50 stocks in the US, you are automatically exposed to the tech sector because all the big companies in the US are tech focused or like comes under the technology sector. Now going into the expense ratio, so this becomes a bit interesting. When one can get all these index funds, right? For example, Nasdaq is an index, you get it for 0.58%, and you get S&P 500 for 0.62%. Why should someone pay 1.27%? That too, it's a direct version, right? It's not a regular version here. So you're paying 1.3%, almost twice what you're paying for these indices for the underperformance, right? So something to keep in mind when it comes to choosing any fund, right? Look into the expense ratio and compare it with the peers, compare it with the standard benchmarks, and see whether it's worth paying the manager. And even if it's worth, even if you think the percentage that you're paying, it's highly unlikely that it's going to continue because the odds are against active management in terms of like the number of funds that underperform their own benchmarks. And like we saw in the risk return chart, right? So in terms of CAGR, again, Nasdaq 100 stands out here. The second best is the top 50. So the more concentrated that you go, almost in the last few years, right? The top 10, top 20 companies in the US, they have been driving the performance of the entire index, right? So, but you also have to know that it comes with a higher volatility as well, right? So it's more volatile than S&P 500 here. Um, so if you kind of look into the correlations here itself, right? So almost like all the major indices are like correlated towards each other, whereas like there are some cases here, right? For example, the US equity opportunities fund, it's not as correlated as let's say Nasdaq or like the top 50, the Nasdaq Q50 index here, right? So something to know about before picking these funds is that sometimes the correlations might be close enough that you don't need to buy two or three different funds at the same time. You can just replace it with one fund itself. So out of all these funds, S&P 500 has the largest amount of holdings here, right, with 500 stocks, and the active fund that we discussed has about 30 stocks in it, so it's more concentrated than rest of them, rest of the international funds, the US focused funds that we are seeing. And Nasdaq fund, as the name says, right, Nasdaq 100, it has 100 stocks in it. Now comes the interesting part, right? The top 10 stocks, the concentration risk is very, very high when it comes to the Mira Asset top 50 as well as the Nasdaq 100. If you see here, the top 50, the top 10 stocks in the Mira Asset top 50 ETF, it's 60%. You're allocating 60% to just top 10 stocks. Same goes for the Nasdaq 100, right? Almost 50% is allocated to the top 10 stocks. So compared to, if you compare that to S&P 500, right, which is more diversified compared to the Nasdaq 100 or the top 50 stocks, it has only 35%. Something to know about these index funds in general before trying to invest into these things. I think that kind of sums up the video. The takeaway here is that there are a lot of index funds in the US, right? Some of them are more diversified than the other. Some of them are more volatile than the other. In the case of Nasdaq 100 and the top 50, these two funds are more volatile than the S&P 500 itself. And at what cost, right? So in terms of performance and key guides, pretty much similar. There isn't a massive difference here. So if you look at the S&P 500 performance, there have been times when it has outperformed the Nasdaq 100 or the top 50 issued by the Mira Asset company, right? We looked into the performance. We looked into the Kiger. No, almost all the Kiger of, like, no, you can see the top three Kigers or the index funds, right? Not the active fund here, which is the Nippon India US, which is charging 1.27 percent, and also another kind of an active ETF, which is like Q50, which is fund of funds, which is also hasn't done well since its inception here. And we also finally looked at the concentration risk, where Nasdaq 100 and the Q50, the top 50, has a heavy concentration risk compared to the S&P 500. That concludes the video. Thanks a lot for watching. See you next time.